this mock exercise, we're going to take a look at the accrual accounting concepts, and we're going to take a look at a question called Hangzhou Corporation. So let's take a look. So this question, Hangzhou had the following selected transactions in the month of November. And the company adjusts its accounts monthly. So what we're asked is for each of the above situation, prepare the monthly adjusting journal entry required at November 30th, and we're asked to prepare any subsequent transaction entries that occur in the month of December. So what we're asked to do is we're asked to record the actual transactions from 1 to 5 for the month of November, and then we're going to take a look at what additional entries do we need to factor in for the month of December. And we're talking about the month end November, okay? Hangzhou has a bi-weekly payroll, so bi-weekly means twice a week, of $6,000. Salaries are normally paid every second Monday for the work completed for the 2 preceding weeks. Employees works a 5-day a week, Monday to Friday, and salary was last paid on Monday, November 23rd. And the next pay will be Monday, December the 7th. Okay, so essentially, the last time we record a salary expense was on Monday, November 23rd for the last 2 preceding weeks. The next salary payment is December the 7th. So what do we have here? So if I was to draw a timeline, and this is Monday, Tuesday, Wednesday, I'll use R for Thursday, Friday, and of course we've got Saturday, Sunday, then I got Monday again, Tuesday. So this would be the 23rd, so November 23rd. So we need to accrue salary expense for the 23rd, 24th, 25th, 26th, 27th. Now, 28th, 29th are both Saturday and Sunday, and the 30th is a Monday, which is the month end. So we've got to record 1, 2, 3, 4, 5, 6. Okay, 6 of the 10 days. So 6,000 is the salary for 10 days. We're going to multiply this by 6 over 10 to give us 3,600. So for November 30th, the adjusting entry that we need to record is debit salary expense, 3,600, credit salary payable, 3,600. And that is what we call an adjusting entry, an accrual entry, because we're trying to capture the expense for the period of work, irrespective of when it's paid. So the fact is that we have incurred a benefit of our employees working for those 6 days up to the month end, means that we need to record a salary expense. Now, on December 7th, which is when it's paid, we got to record a credit to cash because we paid out 10 days worth of salaries. We're going to record debit salary expense for the 4 times 10 days, which is 2,400, and we're going to debit salaries payable for the 3,600. So we're going to record it and we're going to debit. So now we no longer have a liability because we paid it out on December the 7th. Okay, that's transaction number 1. For number 2, what do we have? The company has a 7%, 20,000 notes payable due on September 1st of the next year. Interest is payable the 1st of each month, and it was paid, the last time it was paid was November 1st. And the next time it was paid was December 1st. So presumably what was paid on November 1st would have been for the month of October. Okay, so we would have earned, so we would have incurred expenses, interest expense, because we have a payable in October that was paid in November. So now we need to accrue for the month of November because the payment is not until December. So for number 2, we need to accrue. We need to debit interest expense. And that is for 20,000 times 7%, which is the interest rate, but that's for the yearly rate, times 1 over 12, because that's for 1/12, so 1 month, is $117. I'm just rounding it up. And we're going to credit interest payable. Now, on December 1st, we're going to record it as debit interest payable because no, you no longer owe it, because you now are going to credit cash. Okay, so that's your entry on December 1st. So, for item number 3, what do we have? We have, at the end of November, Hangzhou has $1,000 of invoices that have not yet been sent to customers. So we did some work. We haven't sent the invoices yet to our customers, and that's worth $1,000. It mails these invoices on December 1st and collects the amount on December 21st. So this is the concept called accrual. And in accrual, the concept here is that at the end of accounting period, which in our case was November 30th, we need to capture what revenues were earned or what expenses were incurred, irrespective of when they were received or paid. So in our example, in this particular example, on November 30th, we were able to bill, or we have earned, so we have the right to bill our customer $1,000 worth of invoices in which it was not sent out until December and received payment in December. So this is an example of accrual. And the reason why we need to capture the revenue earned in the right period is through the concept of revenue recognition. And revenue recognition principle says we need to record revenue in the period earned. So, having said that, for item number 3, we need to debit accounts receivable. I'm going to short form that as AR. That's $1,000, and we're going to credit revenue. This is as of November 30th. On December 1st, there'll be no entry to reflect the mailing of invoice. So the fact that we're mailing the invoice, there should be no entry, the physical mailing. But on December 21st, we're going to get cash, debit cash, 1,000, and we're going to credit accounts receivable 1,000, because that's when we're able to collect those bills, the billing. Okay? Let's look at number 4. Number 4 says, as at the end of November, the company earned $10 of interest on cash in its bank account. The bank deposited this amount in the company's bank account November 30th, but the company did not learn of the interest until it receives the bank statement on December 4th. And that's typically what happens. The bank will either take away or deposit funds in your bank account in which you're not aware of until you receive the bank statement. But again, irrespective of that, we need to determine that we need to accrue any revenue that we've earned in the right accounting period. In this case, we have earned $10 worth of interest income. So we need to reflect that in the month of November. So for November 30th, we need to record debit. In this case, it's debit cash because money was already deposited in our bank account for $10, and credit interest revenue, $10. Now, when we physically receive the bank statement on December the 4th, okay, there'll be no entry required because we've already reflected that on November 30th. Okay? For number 5, our last transaction, it says at the end of November, it was estimated the company owed $1,000 of income tax. And this amount was paid on December 18th. Again, this is an example of an accrual. And again, we've incurred an expense in November, but we haven't paid it until December. So here, GAAP requires us to record expenses because of the matching principle. We want to match related expenses against revenues earned for the same period. In this case, we have to pay income tax for the net income that we've earned in November, and we need to record that as an expense in the same period. So the entry for November will be, we're going to debit income tax expense. In this case, it's $1,000. We're going to credit income tax payable. And on December 18th, we're going to debit income tax payable. Which is essentially canceling that out, and we're going to credit cash. Now, if we were to use, so let's use number 5 as an example. If we were to use so this is the accrual basis of accounting. Accrual says we need to record transactions when we earn it, when we incur it, irrespective of when the cash is received. So you'll see that if we were to only focus on transaction number 5, we would show an expense in November, month end November, for $1,000. If we were to use a cash basis of accounting, the difference here is the timing on when this income tax expense is recorded. Because under the cash basis of accounting, we record expense when we pay. In the month of November, there will be no expense recorded, but in the month of December, there will be an income tax expense. So the timing is going to be delayed by a month because the payment was delayed by a month. So that's the difference between accrual and cash basis of accounting. Is accrual is you record it when you've incurred the expense or when you are entitled to receive that revenue, when you've earned it. And then irrespective of when the cash transaction occurs, whereas the cash basis of accounting, you only record the transaction, the economic event, when there's an exchange of cash. And that happens to be in a different period. So if I look at the entire transaction, eventually the company under the accrual and then the cash basis will report a year-to-date the same amount of revenue and expenses, except the timing will be slightly off. Okay, thank you.